And a lot of the studies I found showed.
Well, there's a lot of studies that are stupid in this space.
Hey, Finance Fam, welcome back to my channel. Unfortunately, today there is some Dave Ramsey investing advice that I'm going to have to respond to so that you don't do retirement wrong. Last week, some advice that Dave Ramsey gave on his show about safe withdrawal rates went viral when the professional investing community realized that this advice that he's giving is actually downright borderline dangerous to give. So let's get into what he said, why the data doesn't support what he's saying, and why Dave Ramsey might not be the best person to get investing advice from. So here's the original tweet that Marvin put out. This tweet ended up going viral, 4.3 million views. Let's have a listen at some of the highlights.
As I'm baby step 4, 5, and 6, I have about 120,000 saved for retirement. What was it, a month ago? George Camel released a video that said that the withdrawal rate for a 30-year time horizon should be closer to 3%. So if I can establish financial independence comfortably, then I was wondering if I could ease up on baby step 4 to pay off the house faster.
Okay, I'm a little confused because I don't know what the hell George is doing a 3% withdrawal rate, because that's absolutely wrong. I'm going to have to find out where that video is and get it taken down.
Okay, so when we're talking about safe withdrawal rates from our investing portfolios, what we're talking about is what percentage of our portfolio can we pull out when we start retirement? And then essentially what we do is we take that amount that we pull out in that first year and we adjust it for inflation year after year. So a 4% withdrawal rate, for example, you would take out $40,000 if you have a $1 million portfolio value. You would take out $40,000 in your first year of retirement. That's 4% of $1 million. And then you would adjust it for inflation every single year, that $40,000 adjusted for inflation. So when we're talking about safe withdrawal rates, what we're talking about is finding out what rate will help our money last as long as we live through our retirement years. So Dave continues to become very aggravated by thinking that the withdrawal rate that George told him in the video was too low.
Because that's just wrong. You don't need to have a 3% withdrawal rate. That's ridiculous. Or I hope you misunderstood. I hope we didn't put out trash like that.
Was it 4 to 5%?
No, it shouldn't be 4 to 5%. It ought to be more than that. I mean, if you're making 12 in good mutual funds and the S&P is average 11.8, and if inflation for the last 80 years is average 4%, if you make 12 and you need to leave 4% in there for inflation raises, that leaves you 8.
It's not that simple when we're talking about geometric returns in a portfolio. Okay, there are a lot of things flawed with Dave's elementary math here. When you make 12% a year in your portfolio, inflation is 4 on average, that leaves you with 8% to pull out. It's not considering the fact that not everybody, for one, is going to have a 100% stock portfolio throughout retirement, into and throughout retirement. That's actually a pretty reckless strategy, if you ask me. And it's also not taking into account something called sequence of return risk. Sequence of return risk is basically stating, the risk that your portfolio has a drawdown because of a bear market or a big stock market sell-off in the beginning years of your retirement or any time throughout your retirement. But it becomes more and more impactful if you retire and start drawing out of your portfolio during bear markets or down years in the stock market. So that can really affect how long your money will last, depending on what the sequence is of those bear markets in retirement. In fact, Charles Schwab has a great article outlining sequence of return risk and why timing matters in your portfolio. And they even have this really great visual here showing 2 different investors, right? The first investor experiences a 15% decline during the first 2 years of retirement. So they both start with $1 million, and the investor 1 gets that bear market, or a drawdown. I mean, a 15% decline is actually nothing in comparison to what it could be and what we've seen historically, 30%, even 50% in the 2008 financial crisis. But that's besides the point. And then what happens with investor 2 is they also experience a 15% decline during the 10th and 11th years, so midway through retirement. But look who ends up having more money in the end. The reason that investor 1 has less money, they actually end up spending down their assets. And the reason investor 1 does that and investor 2 doesn't is because of sequence of return risk. The bear market, or the correction, the sell-off, whatever you want to call it, for investor 1 happened in the beginning of their retirement years. Investor 2, the correction or the drawdown didn't happen until mid-retirement. So they had more time to compound their money, and that helped them out when those hard times finally did come in their portfolio. So this is the essence of sequence of return risk, which Dave didn't even mention at all. So what really matters here in terms of sustainability of your portfolio through retirement is going to be things like when corrections or bear markets happen, how steep are the corrections or bear markets, and how long do they last? And then lastly, what is your asset allocation? Because your asset allocation does matter in terms of how much volatility your portfolio is going to experience during the hard times. So no, Dave, it's not as simple as you're going to every year get that 12% return that you can withdraw 8% from after inflation, and you're just going to be fine and dandy. It doesn't work like that. So Nick on Twitter, he's at Dollars and Data on Twitter. He puts out tons of articles backed by data and back testing. I really love it. And he put out this article, How Safe is an 8% Withdrawal Rate, after the Dave Ramsey video went viral. So I was very intrigued. Of course, I wanted to read this. So what Nick did here is he took a mutual fund that Dave would typically use and basically back tested it to see what percentage of the time, depending on the start date of your retirement, would an 8% withdrawal rate have success to where you wouldn't completely run out of money? And what he found is in 58% of these historical simulations, your portfolio does make it. But the other 42%, it runs out of money early. He goes on to say, in particular, if you get quite unlucky, your money would only last a little more than 10 years using an 8% withdrawal rate. So look, here's my question to you. If I came to you and said, hey, you've got this retirement nest egg that you've built, that's great. We're going to start withdrawing 8% and we're going to just adjust it for inflation. That's what our withdrawal rate's going to be. There is a 42% chance that you will run out of money in your lifetime. How does that make you feel? It wouldn't make me feel great at all. And I don't think that that is a chance that I would want to take personally. That just puts it into perspective for you. This is an article from Charles Schwab with some data about safe withdrawal rates based on time horizon and based on, how your portfolio is invested. Is it invested conservatively, meaning you would have more bonds? Is it invested more aggressively, meaning you're going to be a higher stock allocation, if not 100% stocks? And I've looked at many other research pieces, and really it all comes down to the same point. Dave Ramsey 8% withdrawal advice will work great for you, assuming you don't live long. If you plan on having a retirement that's 20, 30, maybe even 40 years long, his advice could become very problematic, especially with looking at the possibility of future stock market returns being lower than they have been historically. So what is the safe withdrawal rate? What is a, good go-to withdrawal rate for your portfolio? Well, first I want to go back to that point about not living long.
And a lot of the studies I found showed
there's a lot of studies that are stupid in this space.
So yeah, if your retirement is only going to be around 10 to 15 years, then an 8% withdrawal rate will probably work fine for you. You're looking at anywhere from 7 to 10% withdrawal rates, even with a conservative portfolio. And that's generally across all risk spectrums or allocations. But look what happens when we start to get into the lengthier retirements. So look at, 25, 30 years. What do these withdrawal rates that are going to give you the most success look like? Well, they're definitely not anywhere close to 8%. They're half that. They're around 4%, give or take, right, across the risk spectrums. So what this is basically saying is if you're not going to live long, sure, 8% is great. But if you have longevity, if you expect longevity, if you want to plan for longevity, an 8% withdrawal rate could get you into big time trouble. And guys, I hate to be the bearer of bad news, but recessions happen. Corrections, bear markets, they can be very significant and put a big ding in your portfolio. And they are bound to happen again in the future. So the timing of these recessions is really important when we're looking at your retirement. Let's keep listening.
So I'm perfectly comfortable drawing 8. But if you want to be a little bit conservative, 7, but sure not 5 or 3.
Okay, so after looking at, what we looked at here in this video, he's starting to sound a little bit stubborn.
Well, and a lot of the studies I found showed
there's a lot of studies that are stupid in this space. So, it's just wrong. Listen, man, the math I just gave you is the math. If you're making 12...
This is so bad. This is so bad on so many levels. I can't believe this man has so many people following his investment advice. Even the caller is trying to say, hey, man, this is what the studies are showing. And Dave interrupts him, completely rude, and interrupts him to say the studies are stupid. The math is the math.
If you're making 12% and inflation is 4 and you leave 4 in there, so your nest egg grows by 4, it's simple. 8 is what's left over. So if you got $1 million and you leave 4%,
it's disturbing.
And so if you want to be a little bit conservative, maybe 5%.
Would you say?
But there's all these goobers out there who have always put this 4% crap in the market, and I'm just irate right now that we have joined the stupidity.
Why is it that stupid, though?
It's too low.
At least Rachel is questioning him. Unfortunately, she ends up agreeing with him in the end because she probably has to, but good on her for questioning him. Why is it that stupid? If the studies are showing it, he's not considering all of the factors around it. So good on Rachel for trying.
Stupid people put out low withdrawal rates. But listen,
Okay, stupid people. Yeah, some of the most professionally trained people in investment management that have actually looked at real data and real back tests.
If you think you can only pull off 4%.
Rachel can't even get a word in edgewise with this. And this is exactly why we actually have something called guardrails. Or, one of the strategies in retirement planning is during years of bear markets or down years in the market, you have a lower withdrawal rate. You pull down your withdrawal rate to kind of not tap out, your retirement in that year with a higher withdrawal rate when the market's down and your value is down. And then in years where the market is up and we're in a bull market, you increase your withdrawal rate a little bit in those years. So basically what you're doing is you're kind of adjusting your withdrawal rate throughout retirement based on what the market is doing and what your portfolio value is looking like. So that is a strategy that he's not even addressing.
S&P to date
was 10%.
Is 10%, and we're not even at the end of the year yet.
Yeah.
And everybody's talking about how bad the economy is. So, most years mine have done much better than 12.
So he is essentially encouraging people to have these 100% stock portfolios because he's saying you can get 12% a year annualized in mutual funds. Well, that would require a 100% stock portfolio.
Yeah.
I'm 62, or 63, I'm pulling nothing off of mine.
Right.
Because I don't need it. I still work. I still have an income.
Right.
I don't need any of it. So it's all just sitting there growing.
But you could do...
Okay, so what he just proved is that he's not living in a world that a retiree living off of retirement is living in. He's not having to actually experience the feeling of being a retiree with no other income. Maybe you have Social Security, but maybe not if you're retired early. No other income except for your portfolio, right? And, not everybody has that situation. It's actually, people will have pensions, people will have Social Security, people may work part-time jobs to kind of supplement income. There are a few people that do live truly off of their portfolios, but not everybody does. But what Dave just proved is that he's not in touch with what it actually is like to be living off of your portfolio and your portfolio alone. Something to think about there.
Go down these stupid nerd rabbit holes in these Reddit threads with these morons who live in their mother's basement with a calculator, and then you put that out into the dadgum community, and then people go, I don't have enough money. It's hopeless. I'll never be able to save enough to retire. $1 million should create for you an $80,000 income, boys and girls. So you should, perpetually, like if forever.
Okay. All right. I think we've seen enough of that. We know that there's a 42% chance, depending on when your retirement started historically, that you would run out of money. So, are you okay with those odds? Really is what it comes down to. Could an 8% portfolio withdrawal rate work? It depends on what the market's doing. It depends on when you retire. It depends on your asset allocation, right? And even then, it depends on how long you live. And even then, there are risks that you have to consider when it comes to this. I think that all in all, Dave Ramsey needs to stick with budgets and credit card pay down strategies and maybe the mental side of money. But when it comes to the investing side of money, I really think that he needs to leave it up to the professionals on this one, because he has made it very, very clear that his analysis is not taking into account the nuances. It's not taking into account the actual way that most people manage their finances going into retirement. They definitely are not going to want to be 100% in stocks, most likely, and no sound financial planner would probably even suggest that. There would be some bulk of the portfolio taken out of risk assets, out of risky stocks, so that you could at least survive your first 5+ years of retirement successfully and not have to worry so much. So, it's going to be really challenging to find somebody that can stomach a 100% stock portfolio into retirement and through retirement. And I think that people need to realize Dave Ramsey's wealthy. He's very rich. He's not going to have to touch any of his retirement accounts until he has to because of required minimum distributions in his 70s. So he's not even going to have to bother with his retirement accounts, and his kids are going to inherit them. So he's completely, out of touch with any of this, to be honest. All right, Finance Fam, what do you think? Do you think Dave Ramsey crossed a line here? Even if you're a fan of his, do you think that maybe he took this one a little too far? I definitely do, and I think you should not listen to him for investing advice. That said, please smash that like button for me, please. And subscribe if you're not subscribed. I love doing these reaction videos. I will probably continue to do Dave Ramsey ones because I want to set the record straight for people, especially in the investing world, which is my forte. I'll see you next time.